Thank you for joining me for this presentation. My name is Brad Renard. I'm the Chief Publisher of Upside Options. And this presentation is after the close on August 19th, 2019. The objective of this presentation is to give a broad market update. We're going to look at the charts and the economic data, and then we're moving our portfolios to 75% long, 25% short. So I'm going to give an overview of our unique methodology to add options-based short exposure to a portfolio for minimal to zero cost. So questions that I will address during this presentation: why has this market been so volatile? Is this market's uptrend over? Can this market go lower over the next couple of months? Should I start to add short exposure to my portfolio? And the answer is yes, and we'll review the trades that we're going to be opening in our own portfolios. When will the next recession hit? And as a reminder, when recessions hit, they usually hit the stocks by minus 30 to minus 50%. What will be the best investment strategies for the balance of 2019? Passive, for example, like index ETFs versus directional or non-directional strategies. Should I sell some of my passive ETFs? Should I trust my investment advisor with all of my money? Just as a reminder, they usually buy broad-based ETFs and they hold. And it's not a good time right now to be holding broad-based index ETFs. The available strategies that Upside Options offers: we have a big cap alpha that buys stocks with strong technicals and fundamentals with a market cap of greater than 10 billion. We have a small and mid cap momentum. So we're buying stocks with strong momentum with a market cap of 250 million to 10 billion. We have a sector rotation. So we're buying the strongest stocks within the strongest industry sectors. We have a contrarian fund. So we buy stocks that have been out of favor for 6 to 12 months and are starting to recover. And then we have Iron Condor Pinnacle. And that's a non-directional, income-generating, conservative, all-weather, options-based strategy that typically generates 2.5 to 5% monthly. Our differentiation, and I just have two more slides here to tell you about Upside Options, and then I'll jump into the presentation. So we use four-level quantamental analysis, where we blend technical, fundamental, and factor-based quantitative analysis. Our strategies are long and short, so we can make money in both directions, and what we're going to cover in this presentation is how we're adding the short positions. We follow strict exit rules, which is rather unique. A lot of money managers do not follow strict exit rules. Thus, we're able to let most of the winners run, but our exit rules are fast enough to lock in gains and to protect capital during strong pullbacks. For example, in October of 2018, we went from 75% allocated to 15% allocated in about 6 days. We finished 2018 at plus 18 to plus 25% gains for our portfolios, where the benchmarks closed 2018 at minus 8 to minus 12%. If you remember, in October of 2018, that's when the market started rolling over, and then we had a 20% correction running through Christmas Eve of 2018. More on the four-level scanner. Step one is we do macro analysis. At the big picture, we're looking at technical, breadth, fundamental, sentiment, and that modulates our bullish and bearish exposure levels. And what we're seeing now is that we want to add some bearish exposure. Step two is a technical scan, and we're finding high probability setups in the charts. Step three is a fundamental screen. So we're looking for strong companies or weak companies. Strong companies for the bullish trades, weak companies for the bearish trades. Step four, we do a quantitative screen for probabilities of a pattern following through. And this is basically econometric, factor-based quantitative analysis. It's using multi-regression analysis, and it generates a lot of probability numbers, and then we use those probabilities to help us make our final selection of stocks. Finally, we use technicals to trigger our entries and our exits. And finally, we allocate about 4 to 5% of the portfolio to each position. So why has the market been so volatile? Well, falling interest rates. The yield on a 10-year treasury is down to 1.5%. We have a flat to an inverted yield curve of U.S. treasuries, and that's predicting a recession in the next 9 to 12 to 15 months. Global economies have been slowing. We're seeing some slowdown in the U.S. economy, and China's economy is slowing, and it's being exacerbated by the tariffs. Here's the chart of the yield of the 10-year treasury. And we can see that the yield has dropped from 3.2% about a year ago down to about 1.5, 1.6%. What this tells us is that money has been pouring into safe haven bonds. So what the bond investors are telling us, and they're classified as the smart money, is that they would rather be in bonds versus stocks, and that they believe that the U.S. economy will slow over the next 6 to 9 to 12 months, and that's why they're buying bonds. So this has been spooking the market. Now, when the yield on the 10-year is dropping like this, you can invert the yield curve. So here's a typical yield curve. And we have years to maturity down here of the bonds. You have 3-month bonds, 2-year bonds, 5, 10s, 15 years, 20 years. Over here on the y-axis is the interest rate of the bond. And in general, the yield curve needs to be upward sloping. That represents a healthy economy, where if someone wants to buy a 2-year bond, they would usually get, interest rate, for example, on this one is 1.3%. And if they're willing to lock up their money for 10 years, they'll get a higher yield, like 2% in this particular chart. And then if they want to lock up their money for 20 years, then they'll get even a higher yield. And also it's anticipating that there will be inflation over those 20 years. That's why they want a higher yield. By the way, this is not accurate, these percentages over here compared to where we are today. This is just a chart showing you 2 different yield curves from the past. So now when you have an inverted yield curve, like we've recently had, it tells you that the rate on the 10-year, the yield on the 10-year is actually lower than the yield on a 3-month, for example, or a 2-year, or the Fed funds rate. And the Fed funds rate is the rate that the Fed controls. So one thing that the Fed needs to do is watch that, and if they want to follow what the bonds market is telling them, then they need to lower their Fed funds rate and lower interest rates and try to bring that down so they can try to create an upward sloping yield curve. Right now we have a flat to inverted yield curve, and that's not healthy. And that could predict a recession within the next 9 months to a year and a half. Another way of looking at the yield curve is just taking the yield on the 10-year Treasury, subtracting the yield on the 2-year Treasury, and then you create a chart. And you can see the difference between the 2-year and the 10-year has been dropping for the last couple of years, and it's pretty much flat. Okay, macro market analysis. Let's look at a weekly chart. One thing that I like to watch is the 1743 exponential moving average on the weekly chart of some of the major indexes. So this one, for example, is the NYSE Composite. It has about 2,400 stocks in it. It's a nice index to follow. This is a weekly chart, so every candlestick represents 1 week of trade. This goes back to 2007 up to about, this one goes just to the end of 2018, but I'm just showing it because show how prescient this chart is. Here's the 17 exponential moving average. This is a weekly. Here's the 43-week exponential moving average. And in general, when the 17 is above the 43, it's telling you you're in a long-term confirmed uptrend. So stay long. Whenever it crosses below, it tells you you are now in a long-term confirmed downtrend. So either stay out of the market, or if you're an experienced trader, you can start going short. So we can see that the 17 crossed below the 43 in January of 2008. Thus, stay out. Or if you're an experienced trader, start going short. And then as of about July, August of 2009, it told you to get back into the market and stay in the market, and pretty much kept you here, but kept you in, but this was choppy right here. So every vertical line that I show here represents a cross. Either this was a bearish cross, this was a bullish cross, this was a bearish cross, bullish cross. We had a bearish cross here, mid-2015 heading into the election. So this was pretty choppy, and this was a hard market to trade right here. Once Trump got elected, the market, we had a bullish cross here. Actually, I don't have a vertical line there, but that was the bullish cross. And it said stay in up until just about the beginning of 2019. So is the broad stock market in a confirmed long-term uptrend? Right now it is. Actually, I'll show another chart that shows you up through 2019, and we're still in a confirmed long-term uptrend. So technical analysis at the macro level, what we're basically doing is we're focusing on the major indexes. So right now I'm showing the NYSE Composite here, but we can look at other indexes, also the S&P 500. We can look at the S&P 400, that's the mid caps, the Qs, that's 100 of the largest technology related companies, and the NASDAQ Composite. And this chart, as I described, shows the 1743 weekly EMA on, this is actually wrong. So this was on the NYSE Composite. Okay, let's look at the S&P 500 and let's zoom in on it. So this one goes to present. We can see that the 17 went below the 43 temporarily, early 2019, and then we're back over. So this market is still in a long-term confirmed uptrend. So we just have to keep that in mind when we watch the market from week to week and as we're making our trading decisions. Let's look at corporate earnings. Macro market analysis continued. So S&P 500 companies are projected to generate about $173 of earnings over the next 4 quarters. This comes from FactSet. We have dates down here as a function of time down here. Blue represents the S&P 500 index. Black represents forward 12-month earnings per share for the 500 S&P 500 companies. And presently, as you can see, that we're kind of around, actually this shows about $176 worth of earnings, and I show 173. So the market is trading right now at 16.7 times earnings, and that's telling me that the market is fairly priced. It's not too expensive, it's not too cheap. So the market is classified as fairly priced, and corporate earnings growth has been flat over the last 2 quarters. So investors have been accepting that and believing that that is okay. Sales growth also is good. It's sitting at around plus 4.1%. Macro analysis continued. Let's look at the economic data. Now this is all positive data. So core retail sales looks good. People are still spending money. Retail sales month to month, you can see that definitely in the last 5 quarters, it's been positive. GDP is projected by the Atlanta Fed to be around 2.2%, so that's really good. Consumer credit. This is revolving and non-revolving credit, basically credit cards and auto loans and consumer loans, and the banks are still lending money and providing credit to consumers. And the more credit that people have, the more money they'll spend. And 70% of our economy is from consumer spending. Economic data continued, and this is more positive data. So the non-farm payroll report, the first Friday of each month, we can see that payrolls are still strong. Jobs market is still strong. Here's the unemployment rate. We're at all-time lows. Here's the 4-week moving average of new claims. So people being fired from their jobs. We can see that companies are just not laying people off at all. And hourly earnings have been climbing. So people are making more money. That puts more money in their pockets, and they're spending more. Economic data continued, and this continues to be positive data. We have consumer confidence, and we can see that the present is this line here, and it's still pretty strong. Inflation is low. This is CPI, so inflation is sitting around 2%, and that's near the Fed's target, and that's good. And interest rates, even though this has been spooking the markets, low interest rates are good for companies. It helps them generate more earnings, so it's actually good for stocks. Economic data on the negative. So manufacturing has been slowing in the United States. This right here represents the New York Fed's ISM, representing their manufacturing. And we can see that it's actually close to zero, so they're not really expanding. That's negative. This is a Chicago ISM. This actually is in contraction territory. This represents manufacturing and or business conditions in general across the Chicago area. So that's negative. This is the Citigroup Economic Surprise Index, and it's been rolling over and going down for the last year. Looks like it's popping up a little bit, but in general, it's just telling us that all the economic data that's been coming in over the last year and a half has been missing expectations. And construction spending, this represents about 5% of GDP, and it's been rolling over for the last year and a half. Worldwide charts, more on the negative. So here's Germany, looks bad. Here's China, looks bad. Here's United Kingdom, looks bad. Here's world minus the United States, and it's been rolling over also. Most of this is caused from the trade war, and until that trade war is resolved, these will continue to look weak. So macro analysis continued. Let's look at the indexes. This is the S&P 500 index, represents 500 large cap stocks. We can see that it was in breakout territory, and then Trump announced additional tariffs, market sold off, and then just a couple days ago, the yield curve inverted, market had another heavy down day. Today we bounced, but we're under the 50-day line, and we're under this 29.47 level here. So we'll probably stay under 29.47 for another week or two. Could this market break back above 29.47 and get back into breakout territory? Well, it could. Just don't know yet. Here is the NASDAQ Composite Index. This looks healthy here. I like this upward sloping line. And so far, the index has been trying to find support on this upward trending line. It's back below breakout, and we'll see. Right now, it's hitting resistance at the 50-day line as of today. Here are the Qs. This represents 100 of the largest, mostly tech stocks. And we can see we're back over 186, which is a positive right here, about 187. And we'll see if we can get back over 191. We kind of have this upward sloping trend line here, and this is a higher high here. So this actually looks pretty healthy. This tells me that we're probably going to we'll probably chop within these two trend lines. This is the NYSE Composite, and this chart looks very weak. This is a lower low, downward sloping, and this is a lower high, downward sloping. We temporarily broke above it, and now we're back down in this range, and we're now below the 200-day line. So we have to give this chart another week or two or three, and we have to see if this can get back out of this channel. If it stays in this channel, this represents a long-term bearish chart pattern. This is the Russell 2000 Index, RUT. Actually, I'm showing the IWM, which is the ETF that tracks the RUT, and this looks pretty bad. So the small caps look weak, and until IWM can get over 160, it's not going to send an all-clear signal to the market. High-yield corporate bonds, HYG. This is also known as junk bonds, And as long as it stays in this range, it tells us that the high yield bond investors feel okay with the strength of the companies that are issuing the debt. And there's a low probability of these companies defaulting on their debt. So we just want to see HYG staying in this range, and currently it looks okay. XLI, this is the industrial sector, and we can see that it just has done nothing for the last year and a half, 18 months. And it's just over its 200-day line. Looks okay, just hasn't done anything. KBE represents banks, and we can see that the banks are down close to the lows down here at $40. And as interest rates come down and as the yield curve flattens, that is not good for banks. XLK, technology companies, and we can see that it looks okay. We're still up here above this breakout level. So tech companies are still doing pretty well. XTN, transports, and transports such as truck, rail, air, that moves products around. And if an economy is doing okay, usually the transports are looking pretty good. We can see that the transports really don't look good. And so this is sending a message that investors believe that the economy is weak or could be weakening. Market breadth. What I show here is the cumulative advanced decline line. And I'm showing it on the NASDAQ composite here and on the S&P 500 index here. This is a decent leading indicator. And we can see that after today's strong up day, it still looks a little weak, telling me that this market could go lower. And I really want this moving average. I show a 17 and a 40 moving average on here, and I really want this moving average back over the 40. This tells me that this market could go lower, and for the S&P 500 cumulative advanced decline line, same thing. This market could go lower. So back to the questions to address. Why has this market been so volatile? Well, mostly because of the yield curve flattening, Trump adding new tariffs, and the yield curve predicting a possible recession within the next 12 months. Is the market's uptrend over? Well, when looking at the SPX, we got as high as 3,025. We could get back up to that. Could we break above 3,025 and actually take out higher highs? I think the probabilities are dropping that that's going to happen. Can this market go lower over the next couple of months? Absolutely. And that's why we're going to start opening short positions in our portfolio. Should I start to add short exposure to my portfolio? Yes. And then we'll cover that and we'll show what we're opening. When will the next recession hit? Probably not this year, probably not until late 2020 if it hits at all. And because we're going through an election, of course, the Trump administration is going to do whatever they can do to keep the economy going. They'll keep on jawboning. They'll keep on pushing the Fed to lower rates. They might be able to keep the economy humming along all the way through 2020. As a reminder, when recessions hit, usually they'll hit the stock market by minus 30 to minus 50% on stocks. What would be the best investment strategies for the balance of 2019? Passives versus directionals and non-directionals. So on passives, just buying ETFs, don't recommend that at all. There's quite a bit of risk on this market going lower. Just make sure if you do buy passive ETFs, just watch them every day and make sure you know when you're going to get out. Make sure you have exit rules set. Non-directionals, we have a strategy called Pinnacle that sells iron condors and credit spread options, and that should continue to do well throughout the year. That's up 20% right now, year to date. And then the directional strategies that we have where we buy stocks. You just need to buy the right stocks, buy the stocks with the highest momentum. And these days, if you can get a plus 5 to plus 10% out of a stock, you're doing pretty well. And then make sure you start opening hedge trades, short trades in that portfolio. And that's what we're going to talk about. Should I sell some of my passive ETFs? Yes, I would. I would just go to cash versus holding any type of index. Should I trust my financial advisor with all of my money? Just a reminder, they just usually buy broad-based ETFs, and many times they'll hold for a long time. And it's not a good time to be holding index ETFs, and financial advisors usually don't follow strict exit rules. They just hold. Here's a question to ask. Ask your financial advisor if you have one. How much does my account need to draw down before you start to sell some of my long stock and ETF positions? And I know some that they will hold them all the way through the next recession. So be aware of that. It's time to allocate 25% of the portfolio to short trades. So let's talk about that. So we open up options-based short trades. They're leveraged so they can quickly appreciate when the market pulls back, usually 3.5% or more. We'll buy puts on the SPY ETF, and we'll write SPX call spreads to pay for these puts. And we'll bring in premium every 2 weeks, and that covers the time decay of these short positions. So here is a chart of the SPY. This is the same as the SPX. It's just 1/10 of the value. We can see that we're at 292, so we're going to buy a put spread. So it's an options-based 90-day short trade. We're going to use an example of a 10K account. We're going to open a 10-wide bear put spread on the SPY. So we're going to buy a put, and then 10 points lower, we're going to sell a put. We'll spend $3 on each position, or $300. This represents a $10,000 account. We're going to open quantity 3, so we're going to spend $900 on the 3 position. And then the trade can quickly appreciate in value whenever the market falls about 3.5% or more. So target appreciation is 80 to 120%, and the max appreciation is 230% on these trades. For example, we have 3 of them at $900, and a typical return is about 100%, so we'll generate $900 pretty quickly if the market pulls back. And then we'll write SPX call spreads to bring in premium every 2 weeks, and that will pay for the time decay of these short trades. And that's bringing in, for the SPX call spreads, we're bringing in about $100 each month, and that does cover the time decay. Okay, so let's look at the trade. So here's the SPY over here, and this is a function of time down here. I'm showing April 10th through present. The horizontal blue line represents the closing value of when I took a snapshot of this trade. So it closed at 288. And here's the trade that I'm opening. I'm buying the 288 put, and I'm selling the 278 put. So I bought quantity 1 of the November 2019 288 put, sold the November 278 put, so there's 10 points between those 2 legs, and paid about $3. And here's the risk-reward graph of this trade. So this is your typical bear put spread. The bottom represents profit and loss. Anything to the right of this vertical line represents profit. Anything to the left represents a loss for the trade. So you can see that I spent $300 on the trade. Here it is right here. So that's how much I spent, and I could lose that $300. However, you have to remember I'm writing call spreads on the SPX, so this is what's unique about what I do. And so I can pay actually for this trade and keep it free. And then if the underlying, here's the underlying here, the SPY, if it starts dropping, you start dropping down into this territory down here, and you can make about 230% on this trade. You can make about $700 because I spent $300 on the put spread, and it can turn into about $700. So to review the trade, it's an options-based short trade, but it needs to be managed every couple of weeks. So these take quite a bit of work. So we need to adjust it and keep it at the money. That is just below the price of the underlying index. And then the call spreads, we have to write those every 2 weeks to bring in premium and to cover the time decay of the trade. So for those, it's recommended use a 5-wide, 2-week in duration SPX call spread. That requires $500 of maintenance. And then select the short call with a 9 to 12 delta. So total allocation for the short position is going to be $300 that we spent on the bear put spread, plus $500 that's being held as maintenance so we can write the call spread. So that's $800 that's actually being used out of the portfolio, or about 8% for a $10,000 account for this short trade. We do quantity 3, that's about $2,400, and that represents the 25% that I was talking about. So about $2,400 out of a $10,000 account, that's about 25% of a $10,000 account that's being allocated to the short trades. So when the SPX declines 3.5% or more, we'll typically get a return of about 80 to 100 to 120% gain on the short trades, and then the max gain on that trade is 230%. But this is pretty rare. We're never going to get anything close to more than 170% gain on that short trade. Most of the time, if we can get 80 to 100%, we're doing well. So we'll book the profit, take it, and then we'll reload it whenever the market rebounds and goes back up to a particular level, like get back up to the 50-day line or get back up above over the 200-day line. Then we'll reload the trade, and then we'll hold it again until the market pulls back again. So let us do the heavy lifting for you. Consider trying one of our services for free, where we do the laborious work of finding fast-growing stocks that are ready to buy. You can receive a continuous stream of high-quality stock picks. And also we can do it for you through auto trading, where you don't have to do anything. We'll also recommend and manage the short positions. So they take a lot of work. We need to roll and adjust the short positions every couple of weeks, and we need to continuously bring in premium by selling call spreads to keep them cheap to free. And consider enabling auto trading. So we'll do all the trading for you in your brokerage account. So we open and close all trades. No action is required by the auto trade client. And as a reminder of what we have the big cap alpha, we have small and mid cap momentum, we have sector rotation, contrarian fund, and then Iron Condor Pinnacle, and that's our non-directional options-based strategy. This one's all options. This one is buying the stock long, and then we have the options for the short position. Thank you very much for your time, and we have free trials available at upsideoptions.net/free-trial. We also have a very robust weekly analysis report that comes out every Sunday, and you can get that at upsideoptions.net/weekly-market-update. If you ever have any questions, please send them to support@upsideoptions.net. Thank you very much for your time, and I'll see you next time.